From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 9th, 2026. Let's see what's happening. How about a dry January self-guided pub crawl on Milwaukee's Mocktail Trail? In a burst of sobriety, all your favorite bars and restaurants are serving up alcohol-free concoctions. So check it out on visitmilwaukee.org. And if you have grandkids, on Sunday it's Gross Out Day at Discovery World. There's a meet and greet with snakes and frogs, a live bug encounter, and the Milwaukee Sewage District has some kind of wastewater presentation.
Oh my gosh.
And they're really charging for this? Your Milwaukee Bucks are making their way home from the West Coast for a Tuesday game with the Timberwolves, and the Packers are in Chicago Saturday night for a big playoff game with the Bears. Okay, here we go. The Chinese government used to have a strict one-child policy in order to curb their population. Well, it worked too well. So now they've changed their mind and asked their citizens to have more sex, please, in order to pump up the population. The government is charging a 13% value-added tax on birth control pills and condoms. Value-added?
Huh?
You think some names of this. Now let's have a moment of reflection and silence at the loss of the MTV music channels. Okay, that's enough. MTV first premiered back in 1981 with the song "Video Killed the Radio Star" by the Buggles. I never heard from them again either. And finally, in Thailand, a fortune teller predicted that a teenage customer would have bad luck on New Year's Eve. Then he stole her iPhone. I guess he can't see into the future. On the podcast today, we have Rothschild Mike Hoelzl, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max, and a great week it was. Dow Jones Industrial Average added 2.3% this week, closing at 49,504 at the end of the day on Friday. The S&P up 1.6%, and the NASDAQ up 1.9% this week. For the year, although it only adds a day to the totals, NASDAQ up 1.8%, the S&P up 1.8%, and the Dow Jones Industrial Average up 3%. And Art, maybe that's a place to start. You know, we got 5 days this week and a day from last week to the year so far, and what a year it's been. No shortage of things, certainly, that could have brought that down this week, and yet here we are already talking about what's been a great start to the year, a lot to go, but it isn't strictly the tech stocks that have been doing the heavy lifting now. You've got the Dow up 3%, the S&P and the NASDAQ right in line with each other. It feels perhaps like we're getting a little broader participation, which was one of the things we've been hoping for a while.
Yeah, that helps. This time of year, it pays to reflect upon what happened, in the prior year. And again, as you just pointed out, what just happened? I mean, we're only, 9-10 days into the year. We've had some major things happening. An invasion of Venezuela, for all practical purposes, rioting in Iran, questions about this economy, still questions about tariffs, questions about whether technology stocks, artificial intelligence stocks are a bubble of some kind. But the broadening helps. But I think it also helps to remember the old adage that a bull market climbs a wall of worry. Last year was the perfect example of why you stay in the game regardless of what happens. So yes, great week, but bigger picture, the economy is still pretty strong. Tariffs didn't turn out to be the bane of our existence as was anticipated last year. There's lots of money out there chasing lots of different things. Bonds had their best year, I think I read somewhere, since 2020. So when you put it all together, what we try to help our investors do is to worry less. And we do that by constructing portfolios that we consider to be balanced as appropriate for the particular clients. And if you just do the math, if you have half your money in the market, if the market goes down on the worry side, okay, you lose 5% instead of 10%. So that's one of the reasons why we're always so cautious. We do not have to know what's going to happen in any given week or on any given day. So great start to the year. Not to mention the January effect, just to pile on for a second. As the market starts the year, it often ends the year. Statistically, that's true. Doesn't mean it has to. But I'm feeling really good about a good year past and a great week now, or a great full week of trading that has us in the positive column.
So my biggest question with kind of everything that we've seen
mainly geopolitically, right? Like Venezuela, you mentioned Iran. You still have Russia, Ukraine, sadly, Israel, Gaza. I'm curious and kind of fascinated, when does that take effect with investors of just saying, you know what, this is one too many things? And I don't have an answer to that. Maybe you guys might, but it just seems that it's just every week, day, month, however, I'm going out of order, you want to do it, there seems to be another something that pops up, and the headlines are always investors digest it and move along quickly. And I'm very fascinated to see what's the breaking point here. Like, is it boots on the ground in Venezuela? Is it an invasion of Cuba, which has been thrown out there? Is it an invasion of Greenland and now going to war with Denmark? I'm kind of laughing at this, but these have all been floated out there. What is kind of the tipping point for investors where they're like, yeah, just there's too much risk in the world for me at this point. I think I'm going to pull back some money.
And I think you add that tariffs are still a big question mark floating out there. You add in some meaningful demographic shift that we've seen, this conversation on artificial intelligence. I think it's the constant reminder that for all the things that have gone right, there's plenty that can go wrong. And I think it speaks hard to what you were talking about the role that balance plays for us. We shouldn't be so naive as to think that any one of those things will be the thing that brings us down, just like we shouldn't be so naive as to think that it's just going to keep going up. We have to be honest and understand that there are things far outside of our control near term as investors. What we can control is our risk. What we can control is how we construct a portfolio to navigate those uncertainties. And so I know, Art, for you, a big focus of what should we be doing going forward is just rebalancing. And how do you have that conversation, especially at a time in which, well, a lot of our clients, a lot of investors are looking at their portfolio and going, well, why don't I just buy more of the thing that's doing well?
Yeah, you have to take into account the fact that trees don't grow to the sky. Price earnings multiples are higher than usual. I'm very optimistic about stocks. I think they're going to go higher, but I don't want to lose my money or all of my money if it goes the other way. So the conversation is one we've had for years, and I've had with my clients on a regular basis. Which would you prefer, to make more or lose less? And you get a pretty good idea when they answer that question, if they do. If they say, gee, I don't know, tell me what to do. Then I say, well, look, you're 70 or 80% in the market. You're 85 years old. Perhaps you're taking a little too much risk. Or you're 45 years old. You've only got 40% of your money in the market. Perhaps you should step up to the plate, because over long periods of time, you're going to do better with more equity exposure. The other thing that's good is diversification, allocating overseas, which, this is the best year. Last year was the best year in, I think, 16 years for overseas investing. I still think, generally speaking, most investors are underweighted. So talk about where the good things are going on or where they might. And back to your question about, gee, what happens when something hits the fan? Well, there's so much money out there chasing things. So better the things we do than the things we don't like cryptocurrencies, which are based on, I can't figure it out. Kyle, you're better at that than I am.
Way to put me on the spot there,
Yeah,
Art. Thank you for that. Maybe we'll skip cryptocurrencies for this podcast, if only to mention that, as I think I've pointed out before, they're really subject to this concept of the greater fool, right? That some things you can place a value on using some measure that's generally accepted. And stocks are the perfect example of, well, at the end of the day, they're really only worth what a buyer is willing to pay to a seller. But there are well accepted methods by which we can value stocks, discounting dividends, discounting future cash flows. There are things about owning a business, being an owner in a corporation, that create an interest in something that can be valued. And so when we look at, for example, what we're willing to pay for a market that's pretty expensive right now, well, I think a lot of folks would argue, well, okay, perhaps we're paying too much, but when you consider that there is some really strong growth being forecast, that discounting that growth by interest rates that we expect to be significantly lower and have certainly gotten lower than where they were, well, okay, maybe I'm willing to pay a little more. And so to Bitcoin specifically, we don't have those models. We don't have some metric by which we can value its future worth. and use that to back into what we're willing to pay for it today. And so what's left is that concept of greater fool. I need somebody else to be a bigger fool than I am to be willing to pay more for something than I'm willing to pay for it. Now, that doesn't mean that there isn't some worth down the road. It doesn't mean that there won't be some mechanism by which we can better understand what these cryptocurrencies should be worth. It does, however, mean that we don't have the history, we don't have the track record, and certainly we don't have the foundation that we do for the investments that we historically look at. Instead, I think you have speculation, and that is certainly what we've seen in those kinds of areas of the market. It is certainly becoming a much more mainstream tool. I think it's fair now to call it an investment, but I would still not call it something which we can fundamentally value because we are much more tied to speculation at this point. And on the other hand, Mike, we have things like the international stock market, which we've been talking about for a while as this potentially really good opportunity. And from a fundamental perspective, again, if that's what we care about, there were all these opportunities going back 5-10 years that just never materialized. Finally, last year, we saw some of that come back and some really meaningful things happening in the non-U.S. space. We have a European economy in particular that looks far stronger than what we thought, and certainly that may drive some interest going forward. And then a lot of big stuff happening in that space right now that maybe makes us as investors want to continue to keep that as a part of our portfolio.
Are you talking about the Olympics?
I'm talking about the Olympics.
I'll get to that in a minute, but it is it's one of the ways I've been telling clients that a way to diversify your portfolio while not necessarily taking your foot off the gas is going into some international stocks if you're a little bit underweight. Because as we've talked about on the show before, they are cheaper than U.S. stocks. Kind of with the tariff conversation and with some other conversations around the world, there's countries are doing deals, like trade deals outside of the U.S., which is boosting them. But then you get into, some, let's talk about it, the Olympics and some potential additional economic activity with people traveling over there from all over the world, or even people within the Eurozone just traveling to Italy and spending more money. If you want to know where I'll be on certain nights, just if you're looking for the race of the snowboards downhill, just know I'll be on my couch watching that. But I think, they are in a much stronger position than I think a lot of people thought, which bodes well for international stocks, which I know for a lot of clients can be I don't want to use the word scary, but I'll use it anyway, because it's not U.S. stocks. It's not what they know. They're not familiar with international companies. But again, a way for them to diversify, why not, and also not be overly conservative, because I don't think you can be in this market, is to go just dip your toe into international a little bit more. Not saying you have to be 50% international, just 10 to 15% will do. And then I think you'll see meaningful returns from that space.
Oh, and I think a lot of investors would be surprised that many of the products they interact with on a daily basis are made by, or at least created by, businesses that aren't directly tied to U.S. corporations. Certainly a lot of the things we interact with are, but I throw out great examples of Nestle chocolate that are a Swiss-made company, even if the chocolate itself you're buying is from here. Well, the parent company is in Switzerland, and they do a lot more than just chocolate, and there's all kinds of examples and reasons why you may want some of that exposure beyond simply that they look a little cheaper. It's an opportunity to participate in a different part of the world with a different source of returns. Joel, we've spent a lot of time talking about some of the uncertainty that's out there right now. I think a lot of it is still fairly nebulous. It's really hard to kind of pin down direct consequence, direct impact. It'll make its way into some of the economic data as we look ahead, but I think we had a lot of reports this week, and not the least of which was some loose data on housing, new construction. But it's been a week in which housing has really been in focus, and so the economic data is kind of a jumping off point for that. Is probably an important piece to understand.
Right, yeah, and I think it's always nebulous, all these numbers that we collect from government sources and trade associations, and it just seems a little more so since the government shut down in October, and they're still trying to figure out putting numbers together. You and I were talking before. I mean, the month of October, we're not going to ever know what the unemployment rate was then, because that was based on household surveys, and there was nobody in the government around to interview households to see whether they were working or looking for work. So, yeah, so we're still trying to put some of those numbers together. Some of the reports that we're getting are later than we expected, but nonetheless, this is what we have. And the numbers on housing this week, we had some reports from the Commerce Department for the month of October, and I think by now we should have like at least November numbers on housing starts and building permits, and it's showing continued weakness. It's showing that we're still not keeping up with the appetite for moving into new houses. We've got one number that I was looking at in recent years that was interesting was housing under construction. And it actually reached, I think in 2022, it reached all-time historic high. And these are numbers going back to 1970. So there was a lot of housing that was going up. But we had so little housing being built right after the Great Recession that we still haven't caught up with it. And that's one of the big problems that we have right now.
Yeah, I know affordability has certainly been part of that conversation, and I think we got a number of announcements this week from the president on what things we might be able to do to at least try to make a dent in that. No formal policy, but certainly some thoughts on what's coming. Things like being able to borrow money from your 401k or just withdraw money from your 401k without consequence that you'd normally have from doing that. Things like preventing corporations from buying single-family homes, and especially encouraging Fannie Mae and Freddie Mac to take on mortgages in a way that they haven't done since the financial crisis, in part because a big cause of the financial crisis was some maybe over-exuberance in that area. Well, all of those are potential policies that could help some of that conversation, right? If we need more housing starts, well, make it a little more affordable for people to borrow to build houses. If we need more people to think about how do we transition from our current home to a new home, well, get more mortgages purchased and hopefully drive down mortgage rates so that people don't feel tied to that 3 or 275 mortgage rate so that they can move from their current home into a new home. And so I think some of what we are seeing there is certainly going to be well received, even if it isn't fully thought out yet.
And yeah, and part of the reason that we are still behind on housing from after the Great Recession is manpower, the staffing, the people to build houses. And so many people lost their jobs, lost their work, lost their livelihoods during that period, that a lot of folks just walked away from the construction industry. And to tell them, hey, let's get back in there because we need housing is a tough sell.
And it takes a while to train those people, right? That you don't just decide I'm going to be a carpenter tomorrow and go to work as a carpenter. You need the skills, you need the tools, you need the understanding of here's how we make sure the building doesn't fall down right after I finish putting it up. And so I think there is an element of even when we make an active decision to pursue more of that work, it takes time to build up that labor force.
It's also an industry that has a lot of immigrant workers. And so when you've got deportations going on, when you've got immigration policies that are getting stricter, that complicates that.
And I would add that many of the people in that industry that historically had been a part of the earlier build-out are getting to that point in their life in which they're thinking about what retirement looks like, and they maybe don't have a plan for who's going to take over this business when I'm not running it anymore. And so I think if you don't have a good pool of labor to pull from, it makes it even harder now to say, that business with all that history doesn't have a game plan for how it operates tomorrow.
This whole discussion is just how complicated these things are. And it's maybe seems simple to come up with various solutions, but no one thing's going to work.
I think the key point you made there, Kyle, was how do you get people to move from like mortgages 2.75 to 3? I mean, I have a 3% mortgage. It will be easier for me to sell one of my kids than to sell my house. Just saying.
And maybe preferable.
Possibly. But I'm just saying, like, I admittedly am part of the problem along with millions of other people because I have no interest in moving right now, even though we could go to a bigger house or do something, because why would I want to pay more? I am locked into this historically low mortgage that's not going anywhere. So I think unless that piece gets fixed, I think it could still be pretty sluggish because, people like me, I'm not moving. Good luck. Like, my wife has talked about it, and honey, I love you for listening to this, but hell no, we're not going anywhere.
Well, and I'm in the market, right? And we're looking at homes and we're looking at building, and part of the calculus for me is exactly what you're talking about. But now, from the person that is looking to move, but who is also going, well, maybe I keep the current house, right? And maybe it's a source of rental income, or maybe it's something that the kids take down the line and become the owners of, and that's their start in life. I think you have a lot of people doing calculus that's a lot different than it used to be, because it's much more favorable to say, well, yeah, it's not going to be that expensive for me to just keep that mortgage for the last 5 years that we're on it, especially when you consider that for somebody else to assume it, for somebody else to step in, well, yeah, it's going to be way more expensive, even if I'm willing to give them a favorable price. And for those looking for my house, if your wife is looking to move, I'd be more than willing to give you a favorable deal if you want to come down to Kenosha. But I think the housing market as a whole is such a big part of our overall picture for household formation, for what family development looks like, and for the consumer. And Joel, we got news on the consumer this week as well.
Yeah, we had several numbers. One was the consumer credit number, the debt that consumers take on through credit cards, and that went down in the month of November on an annual basis. That doesn't happen that often. And actually, a year ago in October, it went down, and it just has been kind of stable since then. I've got in our show notes, I've got a graphic that shows credit card borrowing over the last 20 years, and you can see that it usually is just very steadily up. It went down after the Great Recession. It went down very dramatically with the COVID pandemic, and it's going down now, and it usually doesn't do that.
Yeah, okay, so we're jumping around a little bit here, but then add in what we're seeing from the ISM and manufacturing that's in a contraction at this point. And yeah, still showing signs of broad economic growth. But overall, they're not signs that the economy is growing at 5, 6, 7% that maybe we would hope. Even the 3.5 or 4 that we have kind of been toying with recently, but that growth is slow.
Right. And one of the things that's also slow is jobs. And that's one of the biggest factors that figures into whether people feel good about spending their money is how the job market is. And we had numbers today that all the stuff that I read today, the thing that seemed to sum it up best for me is somebody who said jobs are still hanging in there. So we added 50,000 jobs in December, and that's about the average for what we averaged per month in 2025. That's less than a third of the rate that we were adding jobs in 2024. So we're still adding jobs, but it's a lot weaker. Wages are still outpacing overall inflation, which is good. But other things that I look at, like the temporary help employment, all sorts of things, are not as good. They're a lot weaker.
It's always is the glass half empty or half full. And for investors, the glass, quite frankly, I think is half full. And for the economy, again, it's, who's going to be making more and who's going to be paying more. And the big, beautiful bill or whatever it is going to put a lot more money in the hands of wealthier people. Those with less are going to get something, but net, because of the offset from tariffs, they're the ones who, unfortunately, are going to be borrowing on credit cards. Credit card borrowing going down is actually, from my perspective, a good thing, because they aren't going to be as indebted and having to waste as much money on interest. So when you stand back and you look at the past year and all the chaos caused by worries about and the actual implementation of tariffs and concerns about Ukraine and now Venezuela and everything else, now we're into this year. Of course, Venezuela's this year's new thing. I'm getting more and more confident that no matter what's happening out there, no matter what the statistics are telling us, the wealthier people in this country have more and more money, are spending more and more money, and are investing more and more money. And that could well drive stock prices higher. So not that I'm going to forecast that that's going to happen, but if you're a long-term investor, we look at these little bits of information, put them together, but you can't really form a conclusion because things are constantly changing. As you mentioned before with this housing stuff, it could cause some improvements in the availability of housing, could cause more spending, and furthermore, there could be jobs that are paying more money. There's an article in the Wall Street Journal this week about the shortage of people who replace transmissions in Fords. These people make $160,000 a year. A 30-year-old kid, the owner of the Ford dealership says, would love to clone this kid. Well, we can't clone these people to do this.
Yet.
We have to train people.
Thank you, Joel. Yes, yet.
Maybe get a robot to do it down the road.
No, I think that's part of it, Art. And certainly it's why, amidst the chaos and the volatility it sometimes creates, we as investors have to look at what we're doing and say, despite everything that's going on today, is this still something I want to participate in? Because you're not investing for what's currently happening. You're investing for where you think it's going. And whether it's cloning that 30-year-old mechanic or whether it's replacing them with a robot or whether it's just finding more people that can do that work, that's all future growth potential. And we are still creating those opportunities, sometimes in part because of policy and sometimes despite policy and sometimes just because that's the direction that we are headed. And so I think you put all of this together, I remain encouraged that the economy is strong enough. Certainly it doesn't help when we have the questions we have still outstanding. I think consumers would feel a little better. We might see a little more spending splurge here and there. But maybe that isn't necessary given that we are seeing enough to continue to push investors towards I can look past this one question mark because there is a future in which this is much brighter. And so I think a reminder of why we invest, a reminder of why we take the approach we take, that it isn't strictly about how do we navigate today, but why are we investing for tomorrow. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.